I've been saying it for a while now, but REITs are one of the most interesting asset classes in the market right now. They're currently trading at one of their lowest valuation relative to equities in the last 20 years. And if we simply look at VNQ, the Vanguard Real Estate Index Fund ETF, over the last 3 years, the price return is only about 9% compared to the S&P 500, which is up about 76.54%. REITs are lagging the market by a wide margin. Now, you can argue this is due to a multitude of reasons, but one thing that's for sure true is the market environment that we're currently entering is rapidly different than what we've seen over the last couple of years. The Federal Reserve has already lowered interest rates a couple of times in the last few months, and we're now seeing that on December 10th, the odds markets are showing a 71.6% chance that we'll see yet another interest rate cut. On top of this, we just had a massive earnings season, and 14 of the 20 S&P 500 REITs beat earnings estimates. Now, as I've pointed out before, REITs have historically been an outperforming asset class. In fact, from 2002 to 2021, REITs were the top performing asset class with annualized returns of 11.2% compared to the S&P 500 at 9.5%. If we look at the returns by decades, the 90s was about 13.5% annualized, 2000s 14.2%, in the 2010s about 13.2%. But from 2020 through 2024, the returns were only about 5.5%, far below the average over the last 35 years of 12.4%. Now, anytime we see poor returns really from any asset class, we always have to look at it through the lens of sources of returns. Remember, our three sources of returns are going to be growth and earnings, or in the case of REITs, it'd be adjusted funds from operations per share. We look at dividends, and then we look at the change in the multiple. Have they experienced multiple expansion or multiple contraction? For example, if Vici Properties grew adjusted funds from operations per share at about 4.4% and had a dividend yield of 5.24%, and their multiple expanded by just about 1%, the expected total return would be close to 11%. So what's interesting about this is, despite the sell-off over the last couple of years, quality REITs like Realty Income, which is what we're looking at here, have continued to grow adjusted funds from operations per share every single year. And so as a result, this means that the valuation has been going down, making the investment much more attractive. So the question is, how do we take advantage of this REIT market that's lagged the market by so much over the last few years? It's clear the valuations for quality REITs are looking more attractive than ever. And now that we're entering a more favorable rate environment, and because we now have a record $7 trillion in money markets just waiting to be invested in equities, this is an opportunity that has to be seized. So how can we do exactly that? There's over 1,000 REITs in the world. Where do we start? Well, the key to finding potential REITs to invest in, or really any asset class, is creating what we call an investable universe. I recently created an in-depth video, over 46 minutes long, going over exactly how to analyze REITs. And this was one of the topics that we discussed. The key is to gradually filter out lower quality REITs not growing adjusted funds from operation, or REITs with bad debt metrics or bad payout ratio metrics. And of course, we have to account for valuation. But once we work our way down, we can create an investable universe. This is something I'm a big believer in. And so one of the things that I've been building out really for the last year now over on Dividendology.com, which there's a link to in the description, is building out the Dividendology database. The unfortunate reality for a lot of lesser known asset classes that produce yield, like covered call ETFs, BDCs, and REITs, is that it's really difficult to get quality data on these assets, which is part of the reason that they're so difficult to invest in. We need information as investors to make wise decisions. Now, I love Seeking Alpha. I've been using them for years now. But just as an example, if we look at the most popular REIT, Realty Income, we can see even they're missing data on adjusted funds from operations. They don't have key dividend data such as adjusted funds from operation payout ratio over time. This is what I've been trying to fix over on Dividendology.com. So every month over on Dividendology.com, I provide updates to the Covered Call ETF database, BDC database, Super Investor database, and the REIT database, which I'm actually going to be sharing with you today. So let's just jump straight into it. On our database, we have plenty of information that's extremely difficult data to get. It takes quite a bit of time for me to compile every single month, and I have a guide on how to use this database as well. And what we can see is we currently have 33 different publicly listed REITs in this database right now. So what we're aiming to do is find out how we can take advantage of REITs valuation right now. Where are the best opportunities? Which of these REITs are higher quality? So to do that, let's go ahead and create our REIT investable universe. And the first thing we need to do is find the REITs that are going to be growing adjusted funds from operations on a per share basis. This is essentially the North Star metric for REITs. It's similar to like earnings per share or free cash flow per share for other stocks. It's basically telling us whether or not intrinsic value is growing. Now again, I always have to mention this, but it's so important we look at this on a per share basis. And that's because REITs are required by law to pay out 90% of their earnings in the form of dividends. So if we look at Realty Income on the stock screener, the data will load in thanks to ticker data, but look at shares outstanding. REITs are constantly diluting their shareholders due to the fact that they either have to issue new shares or take on debt to grow the business. Again, it's a result of paying out 90% of their earnings in the form of dividends. This is why we don't just look at adjusted funds from operations, but on a per share basis. So let's go ahead and run the first screen to create our investable universe. If we zoom in on our database, we can see a multitude of metrics such as the historical 3, 5, and 7-year adjusted funds from operations per share growth. So as a baseline, let's only look at REITs that have at least seen positive AFFO per share growth over the last 7 years. This would simply be a way of getting rid of very poorly managed REITs. So let's filter it out and say we want greater than 0%. All of a sudden, our REIT database has gone from 33 down to 26. But let's push things a little bit further. If we zoom back in, you can see we have a column for projected 2025 through 2028 adjusted funds from operations per share compounded annual growth rate. I know that's a mouthful, but essentially what I'm doing here is I'm conglomerating all the analysts' AFFO per share projections for every single REIT. So how fast do we want our REITs to grow adjusted funds from operations? Well, again, let's give them a baseline. Let's say we want this number to be greater than or equal to about 3%. Again, our REIT database has shrunk. It's now down to about 21. So we've already eliminated 12 REITs from our investable universe. So we're off to a good start, but obviously if you're investing in REITs, a large portion of the reason you're doing this is to generate dividend income. So we have to ask ourselves, are the dividends going to be sustainable? So what we want to look for is the adjusted funds from operation payout ratio trend over time. Most people don't state this, but it's absolutely not good enough to just look at a stagnant payout ratio over time. We need to look for changes in the underlying trends. And that's something that I track in the database. What we can see here, let's go ahead and zoom in, is our adjusted funds from payout ratio, is our AFFO payout ratio over time, as well as future projections. Now, the way we get the projections is by accounting for future AFFO per share growth while also looking at projected dividend growth. So let's use Realty Income as an example. What we can see is the trend. Their payout ratio has actually been declining over the past decade. Now, this is a good sign because it means if they chose to do so, they could actually grow their dividend at an even faster rate. So right now, the dividend is pretty much healthier than ever. Now, if they grow adjusted funds from operations and dividends at the rate that analysts are projecting, which again, we can see over on the database. If we scroll over here, we can see the projected dividend CAGR at about 3.6%. And the projected AFFO per share CAGR at about 3.6%, then the end results would be what we see right here. The dividend payout ratio stays in quite a healthy range. That's what we're looking for. So in a way, we've already filtered for this a little bit by making sure the REITs we are buying are actually growing adjusted funds from operation. But let's take it a step further. Let's go ahead and add filters to our 2025 and 2026 forward-looking payout ratio. Let's say that we want the current payout ratio to be less than 80%. Typically, we want to see it probably less than 75%, so we're giving them a little bit of cushion. Now we can see our REIT database is down to 15. We're slimming things up. And just off a quick glance, I can already see the forward 2026 payout ratio looks fine for all of these, so I'm not going to take the time to run a screen there. Now, since we're talking about payout ratio, let's just talk about the dividend in general. This wouldn't be a screen that you have to run, but if you're building out a higher yielding portfolio looking to maximize dividend income, again, this is something that I'm doing with real money over on dividendology.com, then obviously you want to make sure you buy REITs that have a decent dividend yield. I can certainly see some low yielders in our database. So let's run another screen. We'll say we need the starting dividend yield to be greater than at least 4%. All of a sudden, our list really starts slimming up. We're now down to just 8 REITs. Now we need to talk about the debt profile of the REITs. Again, this was something I discussed pretty in depth in this video, so if you're not sure how to do this, be sure to check that out. But one of the things that I've added to the database to almost shortcut that process, or at least speed it up, is I've pulled the latest rating agency, and you can see which agency I was able to pull it from. Now, each agency can slightly vary in what their ratings actually mean, so what I've done is normalized it to an S&P scale so we can compare and contrast. And what I can see just from the eyeball test is all of these REITs are investment grade. So in my opinion, they all already passed the debt mix/maturity check, which leaves us with our last item to create our investable universe, and that's the valuation. It's clear we already have a list now that are higher quality REITs. We can see companies like Realty Income, Brixmor Property, Kimco, Mid-America Apartment Communities, Camden Property, Invitation Homes, Vici Properties, and Gaming and Leisure Properties. These are REITs that have historically been growing adjusted funds from operations. They're projected to continue to do so. They're yielding at least 4%, and we can see a few of them are yielding 7, close to 6, again, close to 6%. We can see they're projected to continue to grow their dividends over time, and their payout ratios look healthy, and then the debt profile looks healthy as well. So let's talk about valuation. Here on the Dividendology database for REITs, one of the things I have is the 5-year average price to AFFO multiple compared to the forward price to AFFO multiple. And what we can see, since all of these are green, is they're currently trading at lower valuations than the historical multiple. Now, obviously, this doesn't 100% every time mean these REITs are undervalued, but this is a really great place to start. For example, if we scroll all the way over, look at Realty Income right now. Maybe we want to run it through a dividend discount model. Let's look at the valuation. Again, thanks to Ticker Data, the data loads in. If we zoom in, let's take a close look at this dividend discount model. What type of dividend growth rate should we apply? Well, again, let's jump over to our database. We can see the projected dividend growth moving forward is about 3.6%. If Realty Income can actually achieve that level of dividend growth, we can see the valuation is about $67.89, giving them 20.5% upside from their current share price. So what we were able to do is filter by quality, look for adjusted funds from operations per share growing, look at the payout ratio trends, look at the debt profile, and ultimately look at the valuation for these REITs to create our investable universe so we can start to dig into where the opportunities actually are. When you're working with these alternative asset classes especially, such as business development companies, REITs, covered call ETFs even, this is the type of process that we want to go through. There's so many bad investments when it comes to these specific asset classes. You have to be so incredibly careful. And when you have a process to create your investable universe, it's going to filter out a large majority of the traps. Now, again, if you want to get access to the database, just check out dividendology.com at the link in the description, or I'll go ahead and put the QR code on the screen right now so you can scan if that's something that works better for you. And on top of this, I'm building out a real money dividend growth and high yield portfolio from scratch over on dividendology.com, so be sure to follow along. So like always, please don't forget to like and subscribe to the channel.